Good evening, everybody, and you're all very welcome along. My name is Michael Shovlin. I'm a lecturer in accounting and finance at GMIT, soon to be the Technological University for the West and the Northwest. And I just want to welcome you this evening on behalf of the Chartered Accountants Northwest Society. Now, ideally, we would meet in a face-to-face situation, and our committee had very ambitious plans for us to arrange events in a number of locations within the region, but unfortunately events have overtaken in the meantime, and regrettably we will not be able to do so at this point in time, but we certainly look forward to planning for a safe return to face-to-face. We have a huge number of participants on the call this evening. At the last count, we had over 90 people on this particular CPD event. We have members from Buncrana to Ballinrobe, from Belmullet to Boyle, and all points in between. And we have a nice mixture of people from industry, from practice, from the public sector. And we are also welcoming a number of other people on our call this evening who are interested in this particular topic. Just before I introduce our two speakers to you this evening, I just want to acknowledge and thank our hard-working and energetic committee. CPD topics like this don't just magic out of nowhere. There is quite an amount of debate and a certain element of argument as to what we can offer our members in the region. And I think you'll find that tonight's topic will resonate with quite a number of you as well. We have two excellent speakers who are very well qualified to speak around our theme of planning for old age, an update on the fair deal, and an overview of the family tax landscape. My understanding is that from a politically correct point of view, it's no longer acceptable to refer to people as elderly or senior. And I think the more politically correct term at the moment is later stage adult. But certainly we're going to hear quite a bit about that along the way. Can I just point out that this evening's event will be recorded? And I just want to make sure that you're aware of that fact. And can I also just suggest that if you have any questions, we're more than happy to deal with those questions as they arise. I'll ask our speakers to address a number of questions after their presentations, and then we'll have a more detailed question and answer session along the way. I'm also just think it's important to point out to you that you'll all accept that neither speaker can provide specific advice or guidance on individual cases or circumstance, but I'm sure they will be happy to engage with you if you have very specific case-specific questions. So without further ado, then I'm going to introduce our first speaker to you this evening. Alton Hines is the National Head of Service for the Nursing Home Support Scheme, or what we know as Fair Deal. It's administered by the Health Service Executive. It's a statutory scheme of financial support to assist clients with the cost of nursing home care. The scheme receives, all told, some 10,000 applications every year, and they have a budget in excess of €1 billion per annum. And as a committee, we felt this was a particularly important topic to deal with, because as we enjoy higher levels of life expectancy, and as we move towards an increasing proportion of our population in that 65 plus cohort, this I think is a topic that has huge professional and indeed personal resonance with all of us. Okay, so I'm delighted to hand you over to Alton, who will take the first talk this evening. Thank you very much.
Thanks, William. Thank you very much for the invitation, Michael. I'm delighted to be able to speak to you. I'm actually speaking to you from the other end of Connacht this evening. I'm down in Portumna in County Galway. So, and I'd just like to say hello to some of my work colleagues in the HSE that I see have joined the call as well. So, I suppose in the first instance, we'll just maybe talk about what we're actually going to talk about this evening. So just give an explanation of what the Fair Deal Scheme actually is. A quick look through the application process, some of the pitfalls around completing the application form. Then I want to talk about the financial assessment, which is, I suppose, the juiciest part in terms of the accountancy world. Also to talk to you about ancillary state support, which is the nursing home loan, and that's an optional loan that some people consider taking. About 15% of clients accept the loan or take the loan every year. And then I also want to talk to you about recent changes to the scheme. And these have got to do with extending the 3-year cap onto family farms and businesses, and also the sale of family home. Now, they relate to a relatively small number of people within the scheme, but if they relate to people, they can have a significant financial benefit. And I also want to talk about further information and advice. Okay, so it's a scheme of financial support to clients deemed to require long-term residential care. It's based on the Nursing Home Support Scheme Act 2009. So that is important. So there's a statutory basis, an explicit statutory basis for the scheme. And the Act itself is extremely detailed. And I suppose what that does is it allows us to have a very, very standardized approach to financial assessments. It gives very, very clear detail on what is and is not allowed and how certain assets are treated. It even goes to the point of giving formulas for calculation of some of the calculations for financial assessment. So that's a really good thing, because it's clear what is and is not people are or are not entitled to. But it also sometimes causes an issue in that there is a black and white issue here, and if something is out, it's out, and if it's in, it's in. So the clarity is there. Most of the time, it's a very, very good thing. Currently, we're supporting 22,300 clients. There's a single national awaiting funding list, and this is issued strictly in chronological order. So basically, once a person is approved for a fair deal, they will get funding within 4 weeks. The average length of stay is 3.1 years. The average funding is in excess of €1 billion, and it will be next year as well. So it's a co-funded scheme, and this means that both the HSE and the client make a contribution. So therefore, there is a requirement for a financial assessment on it for a client, for us to decide what their client contribution will be. It's also a money follows the client funding model. So basically what that means is that a client is approved for funding. The client then decides which nursing home they wish to go to. They go to that nursing home and we make a payment on their behalf. So the HSE doesn't buy beds as such. We just fund the beds that the client wishes to go to. Okay, so in terms of the application process then, there's 3 stages. The first one is the care needs assessment, and I'll just explain that very, very quickly. So basically, what the Act says is that if somebody requires long-term residential care, they can be funded under the scheme. So it's a yes/no situation. There isn't essentially a list of ailments or illnesses that get you in or out. It's very much a holistic view and holistic assessment of clients. So you could have 2 clients with exactly the same medical needs, but one could be living in a house that's very suitable for them with a strong family support and all the other supports. They wouldn't need long-term residential care. A person with the same ailment living someplace else on their own in a rural area without any supports might need it. Okay, so the state support application and the ancillary state support application, which is the optional nursing home loan. So I suppose just in general, the applications are forwarded to the local nursing home support offices. There are 15 of those offices across the country. Galway, Mayo, Roscommon, Sligo, Leitrim, and there's one in Donegal as well. So then the application form, so you can get the application from the local community care offices or your nursing home support offices, and also online at hse.ie. So that's just a slip there of the first page of the application form. So we would say to people, the person who needs care should complete the application form. So if that person doesn't have the capacity to understand the scheme, a specified person may apply on their behalf, and I'll explain who that is in a second. So just in terms of advising people around this, they should complete every part of the application form. There most probably will be some additional documentation required. And if the loan is required and the person doesn't have capacity, a care representative, a registered EPO or committee awarded court will have to apply on their behalf. And the reason for that is because we will be putting a charge on that property, and therefore there has to be a legal sign over to ensure that we can do that. So if somebody is just applying for state support, and I'll move on there, so the specified person, so the person themselves, and then there's a group of people there who have legal authority, committee, attorney with enduring power of attorney, care rep. The rest then are family members. And then at the very end, if there's nobody else, and we do come across cases where people just have no next of kin, they have nobody representing them. So certain people from the HSE can do that. And we would have a number of people, particularly medical social workers in hospitals, who would actually fill out fair deal applications on behalf of certain people who didn't have anybody else to do it. So that's a kind of a cast-off list there, I suppose, essentially. Okay, so we undertake a financial assessment and we look at people's income and their assets. So in very simple terms then, there's a weekly client contribution is calculated. So it's 80% of your income and 7.5% of your assets if you're a single person. Now there's a €36,000 asset disregard. So basically if somebody has €36,000 in the bank and has no other assets, there would be no charge on their assets because that first 36,000 is disregarded. And that can be spread across different assets. So if somebody has 10,000 in the bank and they have a house worth 100,000, the 10,000 won't be charged and the other 26 will be taken off the charge for the house. There are a range of allowable deductions, and a client, in terms of their income, will be left with a minimum of 1/5 of their non-contributory old age pension. Now then, if you're treating couples, so a couple is assessed jointly. So their income and assets are literally added together and divided in two, basically. So assuming one person is in care, we're then looking at 40% of the joint income, 3.75% of their assets. Their asset disregard is doubled to 72,000. The allowable deductions remain the same, and their income left will be minimum single non-contributory and 1/5 of the non-contributory to recognise that we're actually dealing with a couple here. So as I say, a couple is assessed based on the combined income and assets. Now, it is important to note that the HSE reviews the revenue schedule of assets after a client RIP to confirm financial details. So the HSE raises about 7.5 to 8 million euro per annum on this review. So what we find is that in many cases, family members, even sons, daughters, but particularly when nieces and nephews or external people are involved, they won't have the full list of assets and particularly bank accounts. They will pop up obviously when a person dies and their schedule of assets is being dealt with through revenue. And we will put a charge on that. So we will assess what the charge should have been, and there will be a charge put on the estate. So as I say, we collect 7.5 to 8 million euro per annum as part of that review. Okay, so let's take a very simple example then. About 40% of the people who come to Fair Deal will probably fit within this assessment here. So we have a person with a non-con pension, 247. They have savings of 10,000 euro and they're local authority tenants, so they don't have a property. So 80% of income is 197. Cash assets, the 10,000 won't be charged because of the 36,000 disregard. In fact, they could have 36,000, as I said, and the financial contribution will still be zero. We have no relevant assets. So that person's weekly charge is 197.60. Now, realistically, it would take the local NHSO about 10 minutes to do that financial assessment. That's really, really simple. And approximately just under 40% of our clients will be presenting like that. Okay, second example then. A person with state and private pension, 500 euro per week, cash assets of 10,000, and a family home worth 600,000. So again, this is the type of situation that we would see. A person with small savings, a comfortable enough pension, but their house has actually, their principal residence has appreciated in value. And this is very much a feature now of our cities. People who bought houses in the late 1960s, maybe for 3,000 or 4,000 euro, could now be worth, if people in Dublin house worth 1.5 million euro, that type of situation. So their income, this person's assessed income will be 480% of the 500. There's no charge on the cash assets, and 26,000 will roll over here onto the principal residence. So the charge per week on the principal residence on the 600,000 will be 827. Their total charge will be 1,227.90 per week. Now, this is an applicant that we would believe would be interested in the ancillary state support in the loan. So basically, they would take out a loan to cover this part of the charge here, the 827, because that's on the principal residence. This charge will actually fall off at the end of 3 years because it's on a principal private residence, and there's a thing called a 3-year cap. So the charge on the PPR is only for 3 years. So as I say, at the end of the 3 years then, their charge will actually reduce to 400 euro. But this is a person that realistically would be interested in ASS because they don't have the savings to pay to cover that 827 per week, and they certainly don't have the income to cover it because we're already taking 80% of that income. Okay, so then let's look at a couple here. So couple's combined weekly income was 496, savings of 80,000, principal residence of 100,000. So again, we're looking at 40% of the combined income because they're a couple, 198. Cash assets, and again, with the deduction, with the 72,000 disregard, 576, and the principal residence 7211, so 276.51. Again, their retained income will be 297, which is 50% of the combined income plus 20%. Okay, so in terms of allowable deductions, then there's a list of deductions that we assess them. So we take these off their charges. So income tax, PRSI, local property tax, medical cards, allowance for child dependence and full-time education. So this is an interesting one. We have a number of clients within Fair Deal in their 30s and 40s and 50s. And some of these people will have children. So these will be coming probably from ABIs, acquired brain injury, or strokes or car accidents. And there is a significant allowable deductions for them around their children's education and all the other expenses they have around raising a child. So particularly sad situations, but we do have these, and we do our very best to treat those people very, very fairly. So again, if somebody was dealing with one of these people, it's important that they understand that, and that we would always take a very benign view of the assessment for these people. Private medical expenses, less tax relief, certain borrowings, certain redress payments. So if a person is renting out the principal residence, if their partner or child is at home, that's allowable. Maintenance payments in respect of a child, etc. Okay, so let's move on to ancillary state support. So this is an option. You don't have to apply for ASS, but if we look back at the person there who was essentially asset rich and cash poor, they may wish to do this. It's availed of, so the loan is essentially the same as a mortgage, and we need to put a charge on the property. So we have to establish title. Now, no title, no loan, unfortunately. Now, we do have difficulties in certain cases establishing titles, and families do. And it's actually a feature of the west of Ireland. Occasionally we will come across a farm, for instance. So we have a person who's 85 who's going into a nursing home. And when they go and look for the deeds, to find out that the deeds are actually in the name of that person's grandfather. And this was last dealt with in the 1920s or 30s. Now, obviously somebody inherited the farm, and then this person inherited the farm. It was self-evident, so they never actually did the paperwork. But unfortunately, that paperwork has to be done before we're in a position to approve ancillary state support. So we have to ensure that when the loan is paid, that it can be recouped by the revenue commissioners afterwards. So it is a very tight legal document. Essentially, they are applying for a mortgage, and unfortunately, there is no wriggle room on that. And sometimes this can become a very difficult case. Also, obviously, if there's some disputes in the family, obviously, if people aren't willing to sign forms, we have that difficulty as well. But again, if somebody's advising clients on this, that's an issue to watch out for, that the paperwork is actually in place. And I suppose one of the features when we look at delays in processing applications, generally, we can do it quite quickly once the file is complete. The issue is around title, it's around disputes, it's around all these kind of things, and they can slow up cases for many, many months. And I suppose, again, the message that everybody is giving to all of us is that we should have our affairs in order. Okay, so who can apply for a loan? So the applicant themselves. So again, if the applicant doesn't have capacity, you need a person with legal authority. So again, the care representative can be appointed by the circuit court. That could take 6 to 8 weeks, depending on the particular circuit court area you're in. Again, there's a list of people who can do that. They're there on the slide. I'm not going to read through them, but again, that's a kind of a cast-off list there of people who can apply to be a care representative. Registered enduring power of attorney. And again, we get people, yes, I have power of attorney, and then they send it in, and it's power of attorney as opposed to enduring power of attorney. Again, I'm not going to explain to the audience tonight the distinction between that, but the enduring power of attorney also needs to be registered, and again, that can take a number of weeks with the courts when that's done. So that again can delay the application, or obviously a committee awarded court. So as I said, essentially this is a mortgage. It has to be repaid, and the files are effectively court prepared. Okay, so again, in terms of the process, it's part 6 of the application form, and it must be completed and signed by the applicant and the spouse or partner or whoever has legal authority. If it's a joint owner, and that's a case, for instance, where we might have 2 siblings, we might have a brother and sister who inherited a house, and they're both single, and there would be a joint owner in that case as opposed to being a couple. Again, we have to get that title check verification. And once that's in order, we can approve ASS. So people apply, we do the paperwork, and then we offer them ASS through an acknowledgement of consent form. And they need to sign that. That's the legally binding contract then, rather than the application form itself. Now, what is interesting is that about 20% of people for whom we get to the point of issuing the acknowledgement consent form and say, yeah, you're good to go, we're now willing to give you a loan, about 20% of people saying, I'm actually not interested. And that's absolutely fine. So we would strongly advise applicants that if there's any sense that they may need the loan or they may wish to avail of ancillary state support, that they apply for it at the time of application. They can also do it afterwards, but they really should do it at the time of application. And that's a very strong advice we give to people, because it can delay significantly if they leave it until afterwards. They absolutely don't have to accept it, but if they apply, we'll be doing the work in the background, and if they need it, it'll be possible for us to transact that for them very, very quickly. Okay, so when is the loan repaid then? So this is called a relevant event in the legislation. So it's on the death of a client, sale, transfer of the property or part of the property, bankruptcy, or false or misleading information. Now, since 2009, we've actually never came across a case of false or misleading information, and I'm actually not even aware of a bankruptcy, but certainly RIP and sale. So what happens, the HSE will notify the accountable person. So effectively, that's the person who's dealing with the estate, or in the case of sale of a property, it'll probably be the solicitor and the revenue commissioners of the loan amount due. And then the revenue commissioners collect that monies. It's not the HSE. And the monies go into the Paymaster General, they go into the general account, so it goes back into Department of Finance rather than to the HSE. So on the death of a person, they have 12 months to repay the loan, or if it's the sale of the property, they have 6 months from the closing date of the sale. Now, it is possible for a further deferral on the repayments. So let's say, for instance, there was a husband in care and he passed away and they had got ancillary state support and his wife was at home. So she would apply for a further deferral, and then the loan wouldn't be repayable until such time as after her death. Again, there's a list of people who are entitled and eligible to apply for the further deferral. So for instance, if there's a sibling, or if there was a sibling at home, or if there was a person who was caring for the person before they went into the nursing home. Again, that list is there, and those people are entitled to claim for further deferral. CPI interest may be added to the loan repayment amount by the HSE. And if there is a delay in the payment, once that's passed over to revenue, so when you look at the 6 and 12 month deadlines there, if there's a delay in those repayments, revenue may add interest and penalties. Now, that's obviously a matter for revenue. It's gone out of our hands at that stage. Now, I will say to you that revenue are normally quite considerate of genuine cases. And, we haven't seen them really putting significant pressure on people who have genuine reasons why there is a slight delay in their ability to pay this. So certainly we had a number of cases during COVID where, people weren't able to travel to deal with paperwork, etc. And they took, again, a very benign view of that and allowed some extra time for them on that. But ultimately, revenue collect that money, and as I'm sure, as we all know, they are quite good at doing that. Okay, so just to move on then to recent changes to the scheme. So there are 2 changes to the scheme, and these changes came in from the 20th of October, just gone. I'll deal with the second one first, the net proceeds of sale, because that's relatively straightforward. So I suppose the first thing to do is to say to you why this was brought in. So I'd said earlier about the sale of the principal private residence. So after 3 years, we no longer charge 7.5% on the value of the PPR. So that happens automatically. Our IT system identifies that and it's just dropped as a charge. People don't need to do anything about that. However, if the person decided to sell their house, their principal residence, at the end of year 4, which they're entitled to do, before the 20th of October last, we would treat the net proceeds of sale as a cash asset, and it would actually come back again to be charged at 7.5% per annum. So you could see that would be a huge disincentive for somebody to sell their house. So as part of the Housing for All strategy, the government Housing for All strategy, this was identified and it was added as part of the changes to the PPR, to the legislation, I should say. So, it facilitates people selling their properties. Now, there's a number of caveats and a number of things I'll just draw your attention to around that. Firstly, if a person sells their principal private residence before they come into care, it's a cash asset at date of application. So therefore, it will continue to be a cash asset. If they sell their principal private residence, say at the end of year 2, which they are entitled to do, there will be a net proceeds of sale. So we will then assess the value of the NPR until the end of 3 years. And then net proceeds of sale amount is subject to the 3-year cap, and there's no further charge on that. So basically, once you come into the scheme, we will be charging either the value of the PPR or the value of the net proceeds of sale for 3 years. Now, I suppose just to point out to you that if the NPR, the net proceeds of sale, is higher than the valuation of the PPR at date of application, the charge will actually increase because we'll be charging 7.5% of the second figure, which is higher than the first. So therefore, until you get to the end of the 3 years, your weekly charge will actually increase. Now, in current circumstances, it's unlikely that, you know, a property would come to us with a valuation sold 2 years later and that the NPR would be less than the assessed value. Okay, so the 3-year cap on farm and business assets then. So just to talk you through this one. So this has been a particularly relevant topic over the last number of years, and the IFA certainly agitated very strongly that this change would be made. So essentially, this is to deal with family farms and businesses to ensure that they remain viable. So if we had a client, say prior to the 20th of October, let's say we had a client who was in a nursing home for 7 years and they owned a farm, or their partner owned a farm. Their principal private residence, the charge would drop after 3 years, but the value of the farm would continue to be charged for as long as they're in the nursing home. So obviously 7.5% over 10 years is 75%. The asset would be, you know, diminished as years go on. Now, the average length of stay is 3.1 years. 63% of our clients have left the scheme at 3 years. However, we have a number of long stayers. We have people in the scheme 10, 12, 14 years. And there's, you know, particular reasons why they're in nursing home care. Particularly younger people, as in their 50s and 60s, who might get, you know, particular illnesses and they're just absolutely not able to stay at home, but they would live for many, many years. Things like early onset dementia, etc. So there is a group of people out there that this would affect. Okay, so for somebody to be eligible for this, for either a farm or a business asset, then there's a number of conditions of approval. So firstly, you must appoint a family successor. And you nominate a person and the HSE will appoint that person. So again, there's a new application form, and there's a new section 7 of that application form, which is available on the HSE website. So the family successor must commit to running the family or business for 6 years from the date of appointment. And they must complete a statutory declaration to confirm this, and there is some extra documentation that they'll need to provide as well. Now, the farm or business must have been actively run by either the client, that's the person in the nursing home, their partner, or the proposed family successor for at least 3 of the 5 years prior to the admission to care. And again, there's a second statutory declaration that needs to be confirmed or signed to confirm this. So at the end of the 3 years, so assuming we appoint a family successor, at the end of the 3 years, then we will drop the charge on the family farm or business, and at that point we will put a charge on the property, on the assets. So effectively, we'll put a lien on the asset with the Property Registration Authority, and we will remove that at the end of 6 years. So once the family successor has done his time for 6 years, we will then remove that charge from the property at that stage. Now, they won't have to pay anything back. With ancillary state support, you obviously have to pay it back at the end, and we remove the charge at that stage. Here, we just remove the charge, assuming that the family successor has met the requirements. So it is important that there will be confirmation that the family successor continues to actively work the farm or business. And, you know, there would be a check just before we put on the charge, because at the end of 3 years, that's the point at which somebody starts to get financial benefit. And there will be another check then, definitely at the end of the 6 years, so that we can remove the charge from the property and the family successor is relieved of their obligations. Again, it is very, very important for people to understand that, you know, if the requirements are not met, this will be a recoupment event, and whatever financial benefit is gained. So basically, the reduction in the charge on the value of this asset, whatever amount that was paid, that will have to be recouped if the family successor doesn't continue to meet the requirements. Okay, so who can be a family successor then? So there must be 18 years of age or older, the client's partner, a relative, or a son-in-law, daughter-in-law. So a relative is defined in the Act, and again, I'm not going to read this out, but again, it's on the application form and it's on the HSE website on the NHSS section. If you go to section 5 of the HSE website, you'll see all of this detail. So we've picked this up here from the legislation. Essentially what this says is that the 3-year cap, basically what it means is the family successor has to be appointed before you'll get benefit. And you also have to have been in care for 3 years. Now, there's 2 distinct groups of people out there who are potential immediate beneficiaries. And we've had numerous calls and numerous interactions with some of these families over the last number of weeks before and after the 20th of October. And many of these people have now managed to put in an application. So we have residents in nursing homes who have not applied for Fair Deal to date. So that in terms of counting the 3-year cap, adding up those years, it's a period receiving care services rather than being supported by NHSS. So there will be, farmers and business people out there who didn't bother applying for Fair Deal because they did the figures and they realized, look, I'm not going to get anything here because my financial position is greater than, my client contribution will be greater than the cost of care. So therefore, I'm not going to get anything. However, with this benefit now, they're being enticed in. So those people need to apply for Fair Deal. And if they've been in a nursing home for, say, 3.5 years, their 3-year cap is done. So once we appoint the family successor, they will receive immediate financial benefit. So we're saying to those people, you need to apply for Fair Deal and apply for a family successor to be appointed. Now, again, there's residents who are supported by NHSS, and they just need to complete Section 7 of the application form, and we'll be able to process that fairly quickly. Now, the key point here is we have 2 timelines. We have the 3-year cap timeline, which starts from the date that care services commenced. So that's the date that you admitted to the nursing home. And we have the timeline for the family successor, which is a 6-year timeline. And that starts from the date that the family successor is appointed. So I think we might have 1 or 2 family successors appointed, in the last day or two where forms have come through. And they will be required to work that asset for the next 6 years, even though they may be getting financial benefit immediately. So just again, if anybody is advising people like that, just because you're not in the scheme, you are eligible to apply. Your 3 years starts from the date you entered the scheme. The 3 years in terms of the principal private residence also starts from that point. And indeed, we do see people applying for Fair Deal at about 2 years and 11 months from the date they admitted to a nursing home because they want to avail of the 3-year cap on property, and they just didn't bother applying previously, and they didn't bother with the ancillary state support. Okay, so there is supporting evidence required. So obviously we require a statutory declaration to be signed. So I'm just going to work through the one for farms here, right? And everything that's on this, and the Department of Agriculture, Food and the Marine worked very closely with ourselves, the Department of Agriculture, bringing up this list. So everything that we're looking for here, an active farmer already has. This is something that agriculture has already given them. So there is no time involved or there is no cost involved in them producing this documentation. Now, our strong sense is if they're not able to produce this documentation, realistically, they're not actually actively farming the land. So again, a herd number, that herd owner status, and again, there's a distinction between a herd owner and a herd keeper. So the person in the nursing home could be the herd owner, and his son or daughter at home could be the herd keeper. And herd owner, herd keeper is registered. They're appointed under a veterinary legislation. So there's actually the veterinary department with agriculture who manage this. This is actually about the proper the proper keeping of animals. So proof of another DAFM identifier. So again, if somebody isn't into cattle or isn't into milk, partnership, poultry, sheep, equine, pig herd, cereal, fishing vessel, forestry is also included. And again, if there's somebody who's not on that list there, and they're saying, look, I am an active farmer, we will certainly look at that. It is possible that that list is not exhaustive. We're not sure who's not on it. We're not sure who they are, but look, we're pretty confident that we have most of the people. If there's somebody out there who's not in that position, we will absolutely talk to them and we will look at what they've got to say for themselves. And again, the BPS application is probably the go-to for this because the basic payment scheme application lays out the amount of land you have, which should reconcile back to the folio on your Fair Deal application on the valuation of the land. And it also says whether that land is rented or not. So if land is rented to a third party, you won't be able to be eligible for the 3-year cap on either all of that land, or if half your farm is rented, you won't be eligible for the 3-year cap on the part that's rented to a third party because that's not viewed as being actively working a family farm. Okay, so again, other issues there, membership of grain assurance, submission of annual census. Again, these are all things that people in this particular area of farming, they actually have this in their filing cabinet. This is documentation that they absolutely have. There should be no issue with them getting it, and there certainly is no cost to them getting it. So we will be looking for this documentation on a number of times. Certainly when they're signing up at the start of the 3-year cap when the financial benefit is being accrued, and certainly at the end of the 6 years to ensure that the person has completed their time as working the assets for 6 years. And again, scheme registration reference the land or assets, it must be in respect to the assets which is on the the relief is being claimed. So again, we will reconcile the BPS documentation. I think it's actually the last page on the BPS application lists out the land and the folios of the land that the claim is for. And again, a declaration of the forestry parcels on the BPS application is also acceptable. Okay, so again, we have similar rules for businesses. I haven't actually put them up. Farming is relatively tight because it's so well regulated and inspected by agriculture. So we're just literally, utilising what's already there by another state department. And as I said, there's no extra cost or otherwise for applicants. In terms of businesses, the definition of a business is so broad. So really, we'll be looking there for something like, registered tax returns. I mean, if somebody's saying I'm a publican, we'll be looking for a copy of their license. Any other statutory registration that might be required. We will most probably be looking for accounts to show that the business is actually trading, and we'll be looking for some evidence that the person, the family successor, is actually actively involved in running the business. As I say, we really will probably have to work on a case-by-case basis or on an industry sector-by-sector basis in terms of dealing with those. I will say to you that to date, we're not aware of receiving any query in terms of a business for the 3-year cap. We've got numerous queries on farms, but we haven't actually received one yet on businesses. So that's interesting as well. Just again, this is part 7 of the application form for the family successor. So this is a new part of the application form. This is now available on the HSE website. So again, the applicant would sign here, and if it's a couple, and this is the person that they're appointing. So the family successor's details go in here, relationship to the person in care. And again, it's signed by a number of people there. Okay, so I suppose just in terms of fair deal then generally, a number of questions just keep come up. So the applicant, the representative, they can choose their preferred nursing home. That should be considered as early as possible. The nursing home may accept an applicant confirm that they confirm the level of care provided. The nursing home may also decide that they're unable to accept that nursing home. So the maximum weekly charge under the scheme is the published cost of care, and the maximum that a person will pay is their client contribution. So if a person has a client contribution of €200, they could go to the most expensive or the cheapest nursing home under fair deal, and they will still pay €200. A really important point around admission, and this is a significant issue now. There is a contract of care, which is a legal requirement that every nursing home must sign with each individual resident. And it's absolutely vital that people would get their hands on that agreement, if that's contract of care, before admission. They would understand what's in it, particularly extra fees around services that are not covered under fair deal. Now, these fees can go, the HSE care centres don't charge this, but certainly some private nursing homes do. And, the fees can be anything from €10 to €20 per week, into some of the more city areas where we're now seeing fees of up to €100 per week being charged. Now, that is a significant amount of money, as in it's €5,200 per annum. It's a significant amount of money, and people would need to be very, very clear what those charges are before they go into a nursing home. Because once that contract is signed, that is a contract in civil law, and it is a matter between the resident or their legal representative and the private nursing home. As I said, the HSE just makes a payment on people's behalves as opposed to buying beds for people or contracting beds for them. Okay, so the local nursing home support office is probably the first point of contact for people with fair deal applications. We're very strongly referring people to the HSE website. And if you go onto the HSE website, if you put in fair deal into the search engine, you will be brought to our page. Section 5 deals with the new scheme. The HSE live number, they're also, we spend quite a bit of time training those guys there, and they're able to deal with most queries. And if they have a difficult query, they'll actually pass it on to us to a national resolution desk in Tullamore. Okay, that's it really. I'll hand you back.
Okay, Alton, can I just say on behalf of everybody, thank you very much. That was a very comprehensive and insightful presentation, and it was delivered with great clarity. But we do have a number of questions in there for you. So if you don't mind, I might just ask you a couple of questions before I introduce our next speaker. I suppose the first question I wanted to ask was one that just sprung to mind myself, but it's also been asked there. What's the rate of interest on the fair deal loan ancillary state support?
So it's calculated at the consumer price index rate.
Okay. Yeah. So for example, in future years, if inflation takes off, then we're going to see quite a surge in that figure.
Yes, we are.
Okay.
Yeah, absolutely. Yeah. I'm just looking at some of the questions here. Do you want me to run through some of these if I can do it?
If you don't mind,
Yeah.
if you're happy to take them there, thank you.
Yeah, but so if a client is assessed and accepted and subsequently is receipt of an inheritance, yes, they do. If there's any change in their financial position, as in if they receive an inheritance or anything like that, they are obliged to let us know within 10 days. And as well as that, if they were to sell a property, for instance, they will let us know that. Income is calculated after tax, so tax on income is allowable deduction. What if a title to a property is limited owner or elderly person's lifetime? So again, there is a sliding scale of charges that revenue have for people who have lifetime interests, and we use that as well. Now, unfortunately, those people are not eligible for ancillary state support because they're not able to authorise a charge on the property because they don't own it, they have a benefit of it. So how is the person already in arrears with revenue treated? We have no idea about that, and it's not relevant to us. We just quite simply don't know. It's nothing to do with us in terms of arrears and revenue. No.
Okay, then, Alton, thank you very much for that. And again, if there's any other questions relevant to Alton, we'll have a roundup at the end of the presentation. So I'd like to introduce our next speaker to you this evening. The next speaker is Maura Ginty. Maura advises private Irish businesses and families on taxation matters. She has previously worked with KPMG and her career there spans 16 years. She runs her own business, Gintax. She's a member not only of Chartered Accountants Ireland, but she's also a member of the Institute of Taxation. And she's also a high-profile member of our Northwest Committee as well. So I'm delighted to welcome Maura this evening, and I'll hand you over to her next. Thank you very much.
So delighted to be here, Michael, and thank you. I'm going to talk today on these topics. I'm conscious the group is probably a very varied group. We've got accountants and also people who would have been interested in Alton's talk, probably looking at long-term planning, may come from tax a little bit, cold. So I'm going to try and cater for both sects today, and we'll stay low on the jargon, but hopefully also have some insights for accountants who deal with this kind of stuff on a day-to-day basis on taxes. I suppose the good news is just generally tax law really hasn't changed substantially here in the recent past. So I'm not going to go through various conditions. In my slides, I have links to revenue guidance, hyperlinks when you receive the slides, which will take you through the revenue guidance, so you can look at those in your own time. I'm just going to concentrate on areas that probably are more than nuanced or go through examples. One caveat, I'm probably going to cover a lot of content today. I may sometimes go fast. I deal with this kind of stuff on a day-to-day basis. It's my life. So if there's anything that you don't understand or need further clarification on, then please we can engage after the session, or just put a question in the chat box. So we start off a tax presentation with a caveat. Again, it's general, it's overview. Tax is very complicated. I have yet to see any client, I've yet to see the same client scenario in two instances. There's always something different with each client, which I think the accountants in our audience will be aware of. Yeah, so I thought it'd be useful in the context of Alton's presentation, just to kind of highlight where we are with long-term care on the tax side. And from my own perspective, I haven't seen, or none of my clients have been within the Fair Deal scheme, which is very consistent with looking through Alton's calculations. May change now for farmers, and I think that would be very welcome very welcome for the farming lobby. But one of the reasons that there's not particular outcry in this sector or this cohorts of clients is that we do have generous tax reliefs for nursing home expenses or carer costs, and those expenses are one of the only ones available at the 40% or up to the 40% income tax relief. For nursing home expenses, you can actually incur them for anyone, so it need not necessarily be the person the person who's in the home, the family, and generally you try and target so that the people who are paying the higher rate of tax, which kicks in around 35,000 for a single person, gets the tax relief. And always when you're doing the numbers or looking at the fair deal calculation and your income and the cost of nursing home care, try and take into account clearly the tax relief, because it is a real benefit. And for nursing home, there's no actual cap on those nursing home expenses. So you'll see those blue links. So when you get the slides, you'll be able to click in, and that will bring you into the revenue manual on it, which is a good general overview and give you a guide if you're coming to fold. And we all know and love for general medical expenses, you can get 20% of those costs back. Again, they're one of the ones that can apply. You can incur, I can incur medical expenses for Michael and get my tax back. So moving on, right? Kind of thinking about transferring assets and how you go about transferring assets to generally the next generation or as grandchildren. And I thought I'd start at the end and then work towards giving while living, because death and it is relatively, or it's a lot, bizarrely for tax, it's a lot simpler transferring an asset at death. May not be more efficient and may not be the commercially or indeed the I don't know about morality, but it certainly is simpler in that on death we've only one tax, our lovely capital acquisitions tax, which a lot of you would know as inheritance tax. It's also the tax that applies to gift tax. So gift and inheritances have the same regime and broadly the exact same rules. And a lot of you would be familiar with this table. So a child can inherit from their parents in their lifetime, or since the actual rule is since the early 90s. That figure, 335,000 cumulatively over their lifetime. Anything in excess of that is taxable at the 33% rate. So the and then correspondingly, if it's a relative, a grandparent, an uncle, a sibling, 32,000, and a stranger, including an in-law, or indeed someone you're living with but not yet married, it's 16,000. So those rates, especially those for the non-parent, are those thresholds are pretty low generally. And I suppose when you look at it, if you're looking at a kind of a family with 2 children, if they had an estate of 2 million, which would be pretty common enough in kind of Dublin, we'll say, with property prices, you're looking at around a default CAT bill of nearly 500,000 in that circumstance. And even to take it back a step back to someone inheriting a small cottage or a house from their uncle worth about 100,000, you're looking around 20,000 of CAT in that instance. And this is an area it's going to be a lot more popular, I suppose, for want of a better word, in that in the last few years, Irish Revenue have access to the PPS numbers of everyone who's receiving a benefit under a will and knows exactly what's being received. And indeed, I think there might have been a fall, there might have been record keeping may not have been as good in the past. They have a record of what you have received in the past. So just be very wary going forward. It's a lot of people will be becoming more familiar with this table. Why is there not outcry? Because we have lots of CAT reliefs, right? And these are the main ones. And I'll go through them in a bit more, some of them in a bit more detail. They actually are very generous relief in that there's no cap. So we could receive, if you qualify, you could receive a mansion house, a multi-million euro family business, and fully qualify for the relief. Some of them may not eliminate tax entirely, but they eliminate it enough that it's no longer a significant factor in the context of what you're getting. So generally, the tax rate is 33%. With the reliefs, would reduce it to around 3%, or sometimes even a complete exemption. So we go through. The one this used to be a big one, right? The dwelling house relief. And there was a lot of medicine with big properties in Dublin. So a few years ago, it was severely kind of curtailed. And I actually sent these slides to a colleague before earlier on the day. And the picture of the the Tully brothers in Cavan was the one technical issue they had. In my head, I wanted to illustrate exactly who the dwelling house exemption is aimed at, which is basically an adult child would say living with their parent, two bachelor brothers living together, or maybe a cohabiting couple, right? They all very much could fall into this complete exemption dwelling house. It turns out that one of the Tully brothers, maybe two, were married and living like not with each other. My life's a lie. The life's it's a lie. In any case, sorry. Just to go through the conditions, because it's worthwhile. It's worthwhile just just highlighting them more. So I just want you to see that it's not a slam dunk that you may qualify even though you fall into one of those categories. So the homeowner needs to satisfy conditions, and then you as the recipient needs to satisfy conditions. The homeowner is relatively straightforward. It needs to have been your only or main residence at date of death, and there's a carve out there where you have moved away, and that not only can that be a nursing home, but you can move anywhere or move in with a child, or due to your health condition.
Excuse me, Maura. Sorry, just for a moment there. I feel it's a bit like Morning Ireland. Your sound is dropping in and out. I think maybe you're moving back from the microphone, so it's just the sound is dropping.
Okay, sorry. Okay,
apologies for interrupting you there.
Fine. Is this a little bit better if I go nearer the?
That's screen? Better. Yes, absolutely. Yes, okay. Thank you.
Okay, thanks very much, Michael. Sorry about that. For the recipient, so looking at the recipient, the main condition for the recipient is that they can't have another interest in any other residential property. And again, this is one of the ones that there was a bit of flexibility over a couple of years ago, and that has been again changed. There's been a change in law, and it's one actually now it's a kind of a very much it's a potential landmine in that. If you have a will from a parent, and if the parent has some kind of an interest in a property, and it's say a timeshare or something, and it's left in the residue, and you're entitled to the residue, then you may fall foul of it. One thing to are probably where your house is worth a lot, then it's worth kind of considering whether you can fall into, or whether you do fall into dwelling house exemption. Even considering things like shared living, go and live with granny, or maybe granny buys a nice house, and we all move in with her. The one where the owner moves out to, granny moves out to either a nursing home or somewhere else. Maybe another member of the family moves into the home and starts the three-year clock. There is some flexibility as well, where, especially in cases where it's not fully decided as to who the house is going to go to, and then post-death have the house in a trust type structure and leave. And the clock only starts, the actual date for the clock is date of inheritance. It's not actually date of death. So just to be aware that it can have application. The next big one is agricultural relief for transferring on farms, and I suppose this one it's very wide. It's a lot wider than Ulton's criteria for the fair deal. So this is to qualify for CAT relief, to bring that rate down to around the 3% rather than the 33%. And farmers bizarrely can qualify for either agricultural, and if they don't meet the agricultural conditions, they can alternatively qualify for a business relief. And it's something that can very much be managed. But the key thing is just to think about it and maybe talk to your accountant or whatever to make sure that you do qualify, because in the recent past I have there's been a lot of people you speak to casually, or even some clients who talk about, I advise a lot of businesses, and they talk about potentially inheriting a farm, and it turns out that they wouldn't qualify. So in this instance, this is kind of a typical example where someone in business and they have a side interest in farming, or may even indeed have a bit of money and be full-time farmer, and inherit a farm from the uncle. In that circumstance, we'll say they wouldn't satisfy the agricultural relief test. One of the tests is 80% of your assets derived from farm assets. On the business relief, okay, so then we look at business relief, and don't fall in there either, because the owner for business relief, the owner of the land has to have been in business. So a lot of older farmers nowadays, even Ultan alluded to it, are actually renting out their farms, and that means that business relief is also gone in that instance. And I suppose in this instance, they thought they were being very clever in that the rental was qualifying for the tax exemption, for the income tax exemption for the uncle. And just to note that a farmhouse, even if a farmhouse will never qualify for business relief, but does clearly would qualify for, or should qualify for, agricultural relief. There is some flexibility and revenue, except that conacre. So if the uncle in this instance had a conacre arrangement with the nephew, then that would make you fall within CAT. So this can apply even where you'll say, even if a farm is worth, let's say 200,000, if you don't qualify for the reliefs, you're looking at in or around again the 50,000 tax bill. So it's something to think about and plan for. As I said, and we mentioned the IFA lobbying. It's one of the ones where it's actually so broad. I saw the IFA had a pre-budget submission, and they actually were lobbying for agricultural relief to be restricted, so that only applies to genuine farmers. So in our agricultural relief test, we have an active farmer test in tax law, and it's very different from the one that the conditions that Ultan had. So in strict, one of the ones you can qualify for as an active farmer if you lease the farm to someone who's actively farming the land. So, for example, one thing you could do is, we'll say someone's got a whole load of money, let's say 10 million, and wants to gift it to their children. So what they do is rather gift them the cash, right, and have a condition that they invest the cash in farms. The kid goes off and buys farm assets, we'll say vineyard in France, and a lovely villa attached to the vineyard. Rents out that vineyard to the owner, and after 6 years, or year 7, sells the vineyard. So that means that whole transaction qualifies for, that initial gift of the money qualifies for agricultural relief. So rather than, we'll say, the 3 million tax on gifting 10 million, you've just got a lovely small liability of around 300 grand in that kind of circumstance. And that equally applies, rather than vineyard in France, which I don't think the IFA has a problem with, it equally applies to, say, a farm in Carlow or somewhere. Also, another one, just on farmhouses, our Irish law, just a general point, just kind of, Irish law is broad here, and we have a lovely definition of farmhouse, including a mansion house of character, and that is very wide. Interestingly, the UK had similar, we've cogged our law from the UK, they had similar, they took out mansion house a few years ago. We've left ours in, and the Irish Revenue in their guide, which is always why a caveat generally in looking at revenue guides, they don't reference mansion houses. Always worthwhile. You'd always say, especially for the accountants in the audience, looking up the tax law or any commentary on the matter. Other reliefs, just to go through them quickly. I suppose the main one, sometimes people miss out on this one, is if you're due to receive any inheritance from someone domiciled in the USA, then there's a full exemption. This is the 1951 treaty with the inheritance tax treaty with the USA, which is a ridiculously generous relief, and it's relatively straightforward, and the provision is relatively easy. Now, you do see people making an absolute hames of it, so just make just a little bit of care and read it. So, for example, it doesn't apply to gifts, it doesn't apply to Irish property, but if you have a US relative, and it doesn't apply where, you have a US relative and you receive, they've been in the US for years, they regard themselves as a person of the States, and would say they're buried in the States. And we can say that they have gone over there in their 20s or 30s. This is a good argument now that they're non-Irish domiciled or domiciled in California or wherever, and you receive an inheritance, that's just outside the scope of Irish tax. It needs to be under, it can't be under an Irish will. So you see people thinking they're great coming here, coming to Ireland, getting an Irish solicitor, doing up our will, and then you're just back into normal Irish tax. So just a little bit of care around it if it's relevant for you and just want to watch. The other ones, just to note, you see an awful lot of non-Irish domiciled individuals here, and by their nature, they're a little bit more transient, and they're generally within the scope of Irish tax, but only if they're long-term resident here. And if they break residency every 5 years, it can push them outside the scope. So that's one to just probably talk with clients and plan for. And also I'm seeing a lot of, in the last few years, and probably even more so, is the insurance policies, which have been around for donkey's years, but they're becoming more popular too. And I think there is certainly some benefit in them. Even the gift tax one can work well, and it's something that you probably talk to in conjunction with me and the financial planner and figure out what's right for you. Just these ones are just a kind of real traps and alarm bells. If you have a client with any of these, or indeed you yourself with any of these assets, then just to watch out and probably even just think about the inheritance tax aspects, and whether you can plan a bit better in your will, or plan better in your will, or even now for them. So those funds, investment in any funds, generally you should think about the tax. They can be they have different tax treatment to normal assets, and you can have both income tax and CAT on them. So they're probably, to my mind, and I'm not a financial advisor, but they probably aren't the best type of assets if you're holding until death, certainly on the tax side. Now again, they do have commercial advantages. Another one that I see clients kind of fall foul of is, there's a lovely exemption here in Ireland for spousal transfers. And generally everyone's will, or married person's will, has, if they die, it goes to the spouse, and vice versa. Just watch if you have funds also, but if you have foreign assets, because some foreign countries have inheritance tax and there's no exemption for spousal transfers. So you'll have a foreign tax on the death of the first spouse, but nothing. Generally, if you've got foreign tax, it's not the end of the world, you can offset it against Irish tax. But in this instance, if everything's going to the spouse, you can't. So it's very inefficient. So ideally for those assets, you should match them with the recipient who's paying tax, and then you get a lovely offset against your CAT. Pensions, just to watch out for, and just to think about in particular, where you're you have no children and they're going maybe outside the immediate family. Always watch. Business relief can be a very tricky one. Always watch. It's a big area of focus now with Irish revenue, in particular where the business or a company has cash or investment properties. If you're a client, you need to get planning, or don't automatically think that your business qualifies if you have other stuff in your company other than your main business. So you've got excess cash, you start investing in commercial property, that kind of stuff. It may prejudice your business relief eligibility. And I've just put down crypto there. The Irish Revenue have guidance on this, right? But it doesn't cover off where this, where whatever this crypto is located. So, for example, a lot of non-domiciled individuals, US individuals coming over here for a year or two, tech kind of guys, might have crypto. There's probably a technical point that's automatically within the scope of Irish tax based on what the HMRC are saying. And so the HMRC have a lovely detailed guide on it. Ireland, our Irish guide is very, very, very basic. Just watch out. And we'll talk. So that was the easy bit. Transferring to Will Alive is a little bit more complicated, both for tax and also for just general kind of conceptually. Always when chatting to clients, I suppose they'd always be concerned, ensure that they have sufficient monies for themselves. If they've got a business, then it's the whole long thought about whether to transfer, are they the right person, whether to get an external management or on a temporary basis, all these competing factors. And then at the bottom of it all is tax, which can be a significant one, but never let the tax sale wag the dog and always have a thought, and at least, and always with tax, I'd say always be aware of the rules and the reliefs, and in particular some of the age deadlines, which I'll get through. So transferring whilst alive, we have our CAT, which we've talked about. So all of those reliefs are still relevant now to transferring while alive. We also have, on top of it, we welcome capital gains tax, which is our which applies to selling assets. So it doesn't apply to cash, selling assets, anything, a house, shares, farm, based on your original cost over your market value now. So if you gift, an asset, that's also within the scope of capital gains tax, and you're deemed to have received market value proceeds. And we also have stamp duty, which can be negative when I go through in a second. So I just want to, on CAT, since we were talking about it on the death, CAT while living is, there's a couple of more add-ons to it that we could potentially plan for. And I suppose most of you have heard about the £3,000 exemption. So you can give £3,000 to every person, every attendee in this course can give me £3,000, and I will not be subject to tax on that. So it's a lovely way of kind of transferring wealth and kind of manageable bite-sized chunks to the next generation. So in that scenario there, every year that family, those parents, so £6,000 between the couple, it works out around upwards of over 80,000 a year via the £3,000 exemption. So you can imagine over 10 years with that drip, you have eliminated 800 grand from your estate, which is a 33% savings. So it's worthwhile looking at it, even just picking, even if you have a grandchild born and set up a separate account and put the £3,000 in, it works out around 100 grand when they're 18, and sorry, and that's without growth in whatever assets. So that's a common one with and financial advisors will be well enough aware of that one. The other one was our big one, which I'd say a lot of, certainly the accountants here would have been reading the news on, and I suppose the update, if you haven't got it, is that the change to the law hasn't gone through, and the Minister Pascal Donoghue said it's added complications. It's more complicated than thought, and will be deferred or decided not to proceed. Sorry. So here I'll just brief you on the background. And so this is the bank of mum and dad point. So parents could lend money to their children, and generally lending at no interest, right? So generally that would be a gift because you're getting something as a benefit, right? A bank wouldn't give me an interest-free loan. So need to calculate CAT on the interest, and what is the deemed interest rate, right? And our interest rates on deposits accounts, as we all know, is ridiculously low. So the Irish Revenue have confirmed that the rate to pick is the deposit interest rate. That's around 1%, 0.5% now. So if you work back, loan from parents to a child, it needs to be 800 or 800 grand, even more, to even be within the scope of CAT, right? So your loan, the loan to the child isn't triggering any ongoing tax. The child has the money to generally, in fairness, to buy their a residential property, and then they have the property in their ownership, and that increases, that value increases to them. So I suppose the thinking is, in the longer term, in 10 or 15 years time, the property is increased in value, the loan is still the same, and then the repayment of the loan, or sometimes even if it's written off, that's not that big of a tax hit at that point. Also, it gives flexibility. A lot of these people are some people may be, non-domiciled in Ireland, may wishing to be going away in a few years' time, and it's only at that point, if there's a write-off, that's your tax hit. Another really nice one, and this is all still available now for the next year or so, but very much this relief is very much on the chopping block. Is, say a parent has got $1 million in cash, we'll say, and wants to see the lovely commercial property they want to buy. So instead, what they could do is lend the money to the child, and the child invests in the property. The rent roll from the property, generally the child would say, especially if they're in college or young, in a graduate scheme, generally not paying that much tax. So the rent roll is subject to tax on the child, but relatively low. And then the child has funds to provide to the parent to pay down the loan. So ultimately over, we'll say 5, 6, 10 years, the loan is repaid to the parent, and the child has a lovely commercial property with a lovely rent roll in it. So that's fairly common. You can expand that out to add an item. So you can understand the general, how popular it is in the market and the general controversy. I'd say it probably will be talked about in the Commission on Taxation, which we'll be hearing a lot on in spring of next year. And we'll see for next year's budget, but there'll probably be a lot of other general tax things in any event in next year's budget with the Commission looking at just the general taxation strategy and where we're going. Just as a general point, I think just with any of these, and in particular with CAT, I don't think, and from reading the commentary, these reliefs are not going to get any better. I think they're as good as they're going to get for a long time, just for those of you planning. Again, future. Just some other things as well that people are doing, just to be wary of if you are thinking of passing value to the next generation. The next one, I thought it was worthwhile highlighting this on a slide, and this applies to all transfers. And again, it's a deemed market value. So if you gift something to a child, then you've a property to a child or shares, then we're subject to stamp duty. It's generally not a big deal for residential property. People are happy with the 1%, and indeed company shares. Where it gets a real issue and a real stickler is the 7.5% default rate, which is for people in commentary refer to it as for commercial property, but it actually applies. It's just bucket rate for everything. So if you've a pub in your own name, shop, goodwill is a real killer. Now there is an exemption for a complete stamp duty exemption for brand. Now not goodwill, for brand. So this is the one that tax advisors are getting, and I'd say we'll see a lot more commentary on, and a lot more, because it's relevant for other taxes as well. So for example, the transferring the business, even as Ulton said for the HSE Fair Deal scheme, you're gonna, if you actually transfer it, I don't think you actually need to transfer things, it's just appoint a successor, but if you do transfer, then for transferring of a business, then you're looking at the 7.5% stamp duty hit in that instance. The farmers as ever have some really, and again, these are generous reliefs available for them, so they're not subject to the 7.5%. These are the farmers' rates. I'm not going to dwell on it, but just you have the details here, and there's also, just look up farm consolidation relief as well. I have it down, which is also one, so you can see very valuable reliefs as our default is 7.5. Moving on to the big daddy, the CGT, which is often the real killer for transferring assets while living. There's no CGT on death, right, which is the very easy answer. While living, you need to consider CGT on transferring any assets. And again, there are reliefs there. The main one is the principal private residence, which is a lot more generous. We just need to look at the owner this time. We don't need to look at where it's going. The main residence and site to child, again, very, very, very generous. For businesses, two that are targeted have caps on them where we're transferring to a third party, but no cap for transferring, a complete exemption generally for transferring a business to a child. Losses forward, it's always worthwhile looking at losses forward, in that we don't need to silo them. We can have bank losses which you can offset against land. And if you've married a spouse with loads of losses forward, then well done you, because they can go against your gains as well. And we also have potentially a CGT offset. I'll go into some of them. Yeah, I'll go into some of them in a bit more detail. I just thought it useful just to put up a few key points on main residence exemption in particular, because it ties in with the earlier presentation. And again, I'd say the vast majority of people in the country just qualify occupied as your main residence. Generally, people, they buy their forever home, and that's it. And generally, actually, just live in it until death. There is a deemed deemed occupation where you have to move away or move abroad. It also actually, just one thing, the main residence, the law does apply to foreign properties if they were your main residence. The law here is a bit clunky in that it's the time disregarded talks about time working abroad, and it doesn't really tie in with foreign properties. It'd be a good one, actually, useful one. The time spent in a nursing home is also disregarded by the revenue manuals. I don't actually think that that's in the law, so that may be no harm just to plug that in. You know, it's the main point in the last few years, and I think any tax advisor or accountant would say, is that it's very, very difficult to rely fully on what's in the revenue manuals. If you appeal a case, but the tax appeal commissioners, if you appeal a case, then it's really on what's in the law that the tax appeal commissioners can opine on, rather than relying on a nuance of a revenue manual, which isn't worth anything in that context. And just watch if the value of the property is derived from potential redevelopment value, then that element is excluded for the calculation. The other one, I was just, again, this is one that you see a bit, and it's useful just to highlight the cost here, right? So you see individuals, and they're happy to hold these assets, maybe shares or something. So a classic one would be someone who worked in a company for 40 years, a private Irish company, had a bit of a shareholding in it, and then it got diluted, bought out, and still held shares, and they became very valuable. And you're a minority shareholder in this company, happy to hold until death. And then along comes a buyer, and a lovely offer is on the table. All the shareholders are delighted, apart from our Tim here, who was hoping to hold until death and no CGT. So what's Tim's tax position in that circumstance, where we'll say he has a gain of $1 million on the shares, and they're sold. He has no need for the money, so he's just going to transfer to the kids. So this is it essentially. He pays 33% on the gain, giving him 670, which is absolutely fine, but he's no need for the money, and it's all going to go down to the next generation. So then on that, assume in this circumstance they've used up their thresholds. We have another 33%. So you're looking from your 1 million, you're looking at around 450,000 cash after tax. So it's very, very inefficient. So what you want to try and do is, if we have a CGT offset. So if Tim, now again, this is very difficult to predict the future, but it's worth considering and thinking about at the very least. If Tim had gifted the shares to say a child, the child holds them for 2 years and then sells, then you get the offset. So the capital gains tax paid by Tim can offset against the CAT by the child. So your net cash in that instance would be just 670. Now, again, it's predicting the future. Tim's going to be paying tax in that instance on not a real gain, because the assets, the tax event for Tim is transferring on to the child. So there's no cash in the structure, no buyer at that stage. I'm just hoping for a buyer. He's paid the money to revenue, and then the hope is then that when it comes good, the child is able to do the offset. So it works well where in situations where you have an earn out, or where there's a buyout, you retain shares, you know they're going to be sold in a couple of years, and some kind of structure like that, then to think about this, or just to have it on your radar in any event. And now just kind of the other big one for business relief, see how we're doing for time, we're okay, is the other one is retirement relief. So this applies to transfer of businesses, which also includes farms and certain shareholdings. And the key point here to note is there generally is no limit on transferring assets to a child up to around the age of 66, and then limits kick in. It's for transferring to third parties, those are the limits which which have been around for 8 or 9 years or so. So just to illustrate a kind of a typical example, a company worth around 2 million, I want to gift it on to the son, and want some cash for retirement. So just in that scenario, just to talk through, the simple scenario would be totally gift the shares to Dean and no consideration. So in that case, you'd expect to qualify for capital gains tax. You'd expect capital gains tax relief, retirement relief. You'd expect to qualify for CAT business relief, and you'd have a small bit of stamp duty, 1% on the shares. Not a bit, okay, fine. But there isn't another way that you can potentially get money out of the company as well as part of that transaction, which is very common at the moment. And it works very well where we'll say there's the two shareholders can't really, Dean and Barney can't really work together, and Dean has all these new ideas for the business, and there's cash or some cash in the business to fund a buyout. So what would happen is something like this. Barney would gift 80% of his shares to Dean. So Barney has a small shareholding, and then after, see how he goes, maybe see how he goes after a while, how the running the business together goes. Barney ultimately wants to exit the company, which is generally the entity with cash in this instance, buys back Barney's shares, and in this instance, just with the values, they're worth 400,000, and that buyback qualified for retirement relief as well for Barney. So that's a lovely tax-free amount of 400 cash on the table for the owner, which will provide for retirement. Also potentially look at things like the company making Barney an ex gratia payment, especially that works well if they haven't really funded a pension. So this would be a very common one. The reliefs are there. They can be a bit tricky, in particular share buyback to satisfy, but it's worth considering, especially where you have a valuable business and the owner has a need for cash and also a need to appoint a successor. So I think this is my final slide. I just wanted to highlight the key dates, and these are mainly driven by CGT to be thinking about these transfers, and a lot of accountants will be aware of, in particular, the pitfalls and the traps, surrounding spousal ownership. So the main time to think about that is before the age of 55. And another one just to really highlight to a lot of accountants, that changed a couple of years ago, that's section 5997. It's generally, and especially around here where the values aren't that significant, you have a 3 million cap after the age of 66. So people say, so in this scenario, you have a 3 million cap, and you've also, there's a 500,000 cap as well. So you see a scenario like this and you think, oh, that's grand, we'll be fine, we'll be fine doing that at age 70 or whenever. But no, that little change is sneaky enough. It means that when you're taking money out of the company in that scenario, you need to include, Barney needs to include the 2 million along with the 400 for determining whether his 500,000 cap is breached. So that wouldn't, so we wouldn't be able to do this typical exit after 66. And we could do it before. You could transfer what could work is Barney could transfer before 66 the 80% to Dean, and then do the buyback could potentially be done after that, and that should be able to qualify. So just really need to watch that, because it can be tricky, especially when you think 3 million per grand. And just the other one of the commercials for the insurance. So these are my contact details. If anyone wants to engage me, I'd happy to assist. And yeah, thank you. If anyone has any questions, let me know.
Okay, Maura, thank you very much. That was a very thorough insight over a very short period of time. Just for the next maybe 10 or 15 minutes, if any of you would like to ask a question directly to our panelists, can you simply raise your hand and we'll bring you in. If there's any other questions there, please, you can put them in the chat box if you don't want to go live yourself. I suppose one of the things you mentioned there, at least from a tax point of view, there's an advantage to marrying a loser, or at least somebody with losses forward. So there's a compelling case there. Just one question, if I might. You mentioned the €3,000 a year gift that can be made, for example, to grandchildren or children. And I'm thinking particularly of those who might be planning to send their children to college. Is there any formal way that you can do that you can pay into a fund, or how is that best done rather than simply transferring money to a teenager directly?
No. So I know a lot of the financial advisors they've some kind of setup. They have a setup for that. It's held in a separate account, and it's for the child. It's a kind of a bare trust. So it's kind of common enough in the market, and they'd be aware of it. I know then others kind of anecdotally just have a post office account in the child's name and are just plugging it in, every year. I'm not sure whether with KYC or what's the protocol, but I do know anecdotally that's been done as well.
Okay. Also, just maybe for clarity, you talked about this loan from the of mum and dad, and I'm not clear. Is the 0.5% interest, is that charged as income in the hands of the parents as interest, or is it charged on the children?
Yeah, so it's a benefit for the child, right? Because the child is the one that's getting the interest-free loan, so that's good. We all love an interest-free loan. So they're the ones that have the potential liability. So they're the ones. So a lot of the debate, we saw the law in the finance bill, and it was a lot of the debate even was around how do you calculate if it's the law was saying the best rate available to as a borrower, but is it the borrower is you, the child, or the parent? That was a bit of debate and very fuzzy. So I think it's just all scrapped in the last week, the change.
Okay, we have a question in there for you. Does rent of non-agriculture assets qualify as business?
Generally not, right? But there is potentially some flexibility there. So for example, we'll say if one that's very common in the market is Airbnb. So if you have a very busy Airbnb in a busy town, a lot of rollover, then that can potentially, that may potentially qualify. But generally rent is very, there's a specific carve out for renting assets like that.
Okay. Can I just ask then if there's any questions for Alton or for Maura? I think it's a little bit like this celebrity antique show now. We're going to go once, go twice. Is there any offers from inside the room or outside the room? Okay, if there's no further questions, then can I just wrap up this evening's proceedings, first of all, by saying a big thank you to both our speakers who covered a vast amount of material in a very short period of time. In a little over 90 minutes, we've covered, I think, what would normally be done in a half-day event. I also want to say a special word of thanks to those behind the scenes, in particular, Kathy McDermott and Arlene Gibbs. They're like the great Oz behind all of this with all of the technology and taking care of us all. And I suppose the last thing maybe just, we are very limited as a society in what we can do socially at the moment. And one of the ideas that we did have is to remember the founding chairperson of the Chartered Accountants Northwest Society, Declan Walsh, who sadly passed away in September. So there is an event there which is just flagged on your screen. And as well as Declan has been a founding chairperson of the Northwest Society, he was also instrumental in the founding of the Neurology Support Centre in Sligo. So hopefully you will be able to join members of the Society at this social event, which is 10 years of theme nights featuring Kieran Quinn, or indeed if you would like to make a donation to the Neurology Support Centre in Sligo. Okay, so just on behalf of the committee and everyone else, I want to thank you all for your attention this evening. Of course, the material will be available to you subsequently. I do remember as a student, the one question that always went up is, will there be handouts? And while there are no handouts tonight, we are happy to share the presentation with you. Okay, so on that basis then, can I just say thank you very much and good evening.